Hello, ladies and gentlemen. I am O'Brien McMahon, and this is People Business. In this episode, I am joined by Spencer Smith. Spencer is a Senior Vice President of Sales at ParetoHealth, which is a healthcare captive. He is also the host of Self-Funded with Spencer, a podcast that talks all about self-funding and the world of corporate medical plans. This is admittedly an episode where we go a little bit niche. Some of them are very broad, principles first, human topics. This one is a little bit more specific, but so many companies out there are struggling with rising healthcare costs. This is the world I live in every day as a benefits broker and consultant with Lockton. And I'm having this conversation more and more and more. Does it make sense to look at self-funding versus a traditional kind of fully insured, all I do is pay my premium policy? What is the lift? What are the benefits? Can I do it at my size? Would it make sense to do it traditionally, or do I need to do it through a different arrangement like a captive, which is what Spencer will talk about, what that means and how they do it at Pareto versus other places. And so just because this is such a rising topic, I thought it would be important to bring Spencer on. He does a great job. We start at 101 and we kind of build and end up getting into the deep end here for folks. So if you are self-funded, bear with us for the first couple minutes where we lay the foundation. If you're not, don't worry. We start simple and sort of build on top of it. So hopefully it's easy to understand. And I really hope that this helps people. I hope it helps you through your medical renewal planning cycle this year. And I hope it prompts you to maybe think a little bit differently, maybe explore some things that in your mind were closed off as options to you, because there are some real challenges out there in the market right now. And at the same time, there are also some solutions. So I hope you enjoy this. If you like it, if you have any questions, reach out to me. Happy to engage in these topics. Reach out to Spencer. He loves engaging in these topics. And I hope you enjoy. Here is Spencer Smith. Spencer, I feel like I have a celebrity in the employee benefit space on the show today. You do your show, Self-Funded with Spencer, and we're going to go niche today. Yeah. Some of the topics on here are broad, but we're going to go niche into the health plan world and talk about different funding mechanisms today, which, believe it or not, audience, will be a fun conversation. So stick around.
Well, I hope so, man. That's the fun in self-funding, right? But I cringe when people say famous or whatever. I'm like, it's like a little bitty niche that maybe a few people know about, but it's always weird to hear that said. But I appreciate the kind words, man.
Yeah. Well, what's that country song? I'm famous in a small town.
Yeah. In the small town called the self-funded benefits world.
There you go.
Yeah.
So how did you come to start a podcast on self-funded medical plans? Give me the origin story.
I'll give you the genesis story. It's actually a two-part story. So it didn't start with a podcast, O'Brien. It actually started with whiteboarding stop-loss videos during COVID, where I was a sales guy at the time. I was going, man, nobody wants to meet anymore. Zooms weren't normal like they are today. And I thought, well, Dr. Eric Bricker does these whiteboard videos, and he's good at teaching on that. Why don't I try that? And so the co-working space I was using had whiteboard conference centers, and it was like the whole wall was a whiteboard, like a blank canvas. So I thought, what do I know? I know stop-loss pretty well. I also had the thought, nobody else teaches it. It's not out there, readily accessible. So why don't I do that? And so I did a stop loss 101 video, uploaded it to LinkedIn, didn't know what I was doing. I was on an iPhone, no lighting, anything. And it circulated a lot on LinkedIn. It trended a couple times on the whole platform. And it was like lightning in a bottle to catch the first time around. But it reinforced, oh, there's a there. So why don't you keep doing that? And I did that for about 25 weeks. Then I ran out of ideas, right? Of whiteboarding on stop loss insurance. And so I'd always had this idea in the back of my mind, what about a podcast? Because what does that do? Just like you obviously know the platform, it allows you to have other people come on your show and they have varying vantage points or areas of expertise. So why don't I flip the script and let other people be the experts on the subject? But I'll do it around the ecosystem that I still understand, which is self-funding and self-insurance. And it has snowballed over the course of 5 years and coming up 250 episodes as well, which is crazy to think.
Congratulations. Yeah, I'm sitting at 230 and I can say firsthand that's a lot.
Well, I applaud you, man. Most people, I think the stat is most people don't get past episode 8. Literally, you're the top 1%. So the fact that you've been doing it for 200 plus episodes is phenomenal. So kudos to you, man.
Yeah, well, back at you. Back at you. So let's like start at the foundational level and we'll build, because I want to make sure that people who are not self-funded understand what it is and what we're talking about, so we don't like go over the top of their heads. But then I want to get into the deep end too, so people who are managing self-funded plans today, that there's some stuff from them. It's not just a 101. So
Sure.
if you're new, we'll dive in here. If you are old hat at this, just stick around for a little bit. We'll get there. And I think this is especially important just given the benefits market that we just went through, the expenses that are rising on companies' balance sheets when it comes to medical plans. So let's just talk, what is the difference between a fully insured plan and a self-funded plan?
It's my favorite question. And one of my goals in life is, how do you answer this question as simply as possible so everybody can understand? There's two ways I'm going to go about it, but I'll combine the two. I think about it in the way that you might have, if you've ever bought a car, right, and you go in the finance department, what is the thing that they try to upsell you when you're in there is some sort of warranty or maintenance plan, right? Think about what a maintenance plan is supposed to cover. Tire rotations, oil changes, things like that. And they'll tell you for only $50 more a month, those things will be covered now, so you don't have to worry about it. And what is the problem with that? One, they have margin baked into that. And two, there's an interest rate on top of it as well. So you're financing those things. But what are we really talking about? Very routine, not very frequent maintenance things that you do for your car. So if you start to do the math, you go, well, I get an oil change maybe once a year, call it $100. Tire rotations conceivably can be free at a discount tire. Hopefully I don't hit the curb every once in a while so I can avoid the cost there. And you start to realize the total of what I would spend for those things is far greater than what I'd spend if I self-funded my own maintenance, which is what we're talking about. And so I think about it for health insurance is the same way. If I'm an employer and I'm fully insured, I'm prepaying for all of the risk on my plan at 12 months at a time, but I'm prepaying with margin and an unknown interest rate, which we'll get into in a second, where I'm pre-funding things like labs, x-rays, MRIs, very routine, repeatable services that have a relatively low price tag. So if I insure all those things, what does that do to my premium over time? It increases it substantially because everything that's insured now becomes part of the pretense to raise my premium. So what is self-funding in a nutshell? It's an employer deciding I'm going to stop prepaying for my claims and I'm going to buy a level of insurance like car insurance would be, where you have a catastrophic level of protection, but all the routine little stuff, I as an employer am now going to pay out of my balance sheet or out of my bottom line, if you will. And that to me is where the efficiencies get reintroduced into the equation. An employer gets the benefit of what they don't spend all the money in a given year, they keep that money. So it's a difference of prepaying versus paying as you go for your healthcare costs.
And what do you see as the benefits? Is it just that initial cost that, well, hey, if I run better, I'll save more, or are there other benefits as well?
Well, it's a great question. And most people, I presume every conversation I'm having at my company in a sales setting is, I know that employer wants to save money. Duh, who doesn't want to save money? And then it becomes, what else is important to you? Have you seen the quality of your benefits erode over time because you're trying to offset fully insured increases? What if we could do both simultaneously? Have you for the potential in any given year to dramatically lower costs and also improve the quality of the plan design and the benefits that you offer? So that's one. Another that is often not talked about enough is you get zero or very limited data about what's happening in your plan when you stay fully insured. When you go self-funded, especially with an independent TPA or administrator, now you have the opportunity for a treasure trove of claims, data analytics, case management notes, and I could bore people that are listening to this. But the reality is I'm a big believer you can't manage what you can't measure. And right now you have nothing to measure in your fully insured plan. So the data is going to be really powerful as well.
So are you of the mindset that self-funding makes sense? Every company out there should be self-funded, or are there situations where you see fully insured plans still making sense?
Yeah, I'm very careful not to be like a self-funded sycophant and say everybody should be self-funded and you're dumb if you're fully insured. That's absolutely not the case. The same with captive, same with self-insured on your own. It's always going to be on a case-by-case basis. I am a believer on average, though, far more employers should be self-funded than they are today. And what we're starting to see is you're seeing market share leakage in the fully insured world the last 3 years. You mentioned up front the kind of hemorrhaging of business through really high renewals that happened last year, caught some people off guard. And so there are circumstances. I'll give you a great circumstance. Really healthy risk pool. I have 1 or 2 very large claimants on the plan. And right now, overall, maybe I'm on a table rate situation where I'm community rated, or I'm just in a risk pool where I am underpriced myself relative to the risk I actually have on my plan. Stay, right? Or if there's a large claim that's going to be ongoing that really doesn't have a solution for it, you're likely still better off in the short term, staying fully insured until that person either leaves the plan or you come up with a solution for it. And I can give other examples, but I am careful not to say everybody should be self-funded because I think that's actually bad advice.
Yeah. And I do think there's an element of it too, where this is a year to year conversation. So
Yep. Yep.
just because it doesn't make sense this year doesn't mean it won't make sense next year. Like it's, especially in the first years when you're going to flip that switch, you want it to make sense. And there might be a couple of years in a row, like you said, where the market is willing to buy your business and they're willing to take on more risk than your broker would think the actual risk to be.
Yeah. The way I look at it is in any given year, you can spend more being self-funded. But on average over time, which one of my mentors, Dave Ross, used to say, on average over time, you're all but assured to save money relative to what would have happened fully insured. And so when you consider this as a switch in the way that you fund your plan, you have to be thinking on a multi-year basis. And most people get stuck in the fully insured world just thinking 12 months at a time.
Yeah. And that's a conversation that we're having more and more of at work too. The numbers are the same this year. And so we'll push the can down the road. We'll take the fully insured plan because the risk is the same. We might as well put the risk there. But I think when you stretch the lens through which you're looking at this and you look out multiple years, it's okay, well, that could be true this year, but then next year you're going to get a trend increase on your fully insured plan, and self-funded might make sense, but you've missed that gap. Like a gap has started to open and you've missed that savings. And so you got to look at it on a 3 to 5 year trajectory of what could happen and how wide does that gap potentially get with trend over time.
And I think about it, to use your analogy again, the kicking the can down the road, I like to add that analogy and say, if you keep kicking it down the road, it's going to gather rocks and pebbles inside that can. And then the next time you go to kick it, it might hurt quite a bit when you try to kick it. And so you get a lot of employers that get stuck and think, oh, next year, it'll be better next year. It'll be better next year. The reality is because the underlying cost of care continuing to go up every single year, every year you look at it, it will most likely look like it'll cost more money in this year versus last year. And so I would strongly encourage groups that are still getting single digit increases or getting flat renewals sometimes. That is the year to look at self-insurance because you're got a clean risk profile most likely. You're overfunding your plan and you actually have a higher opportunity of saving money than somebody that's in a desperate situation and looking at self-insurance as a way to save them instead.
Yeah. You mentioned Dr. Eric Bricker, which we'll link to his website, A Healthcare Z, which those videos are great. And I and others have used those videos to increase my own knowledge. He had a video the other day that I saw, and I'd just be curious your take on this. I don't know if you had the insight. It might be just too much of a black box, but he made the argument that, let me back up for a second. There's a term, a plan gets into a death spiral, which means that the costs go up. And so therefore you have to raise the premiums. That pushes the healthy people off your plan. So only the sick people stay on your plan, which then drives your premium up even more, which then drives more healthy people off the plan. And you get into this bad loop. He made the argument that the fully insured market itself may be in a death spiral where the rates are going up at such a level that it is pushing more and more good risk off into the self-funded space. Have you seen anything to indicate that is happening other than just it makes sense logically because rates are going up so much?
It's logical. And I think I agree with Dr. Bricker and I'll give you some rationale as to why. Average increase last year across the fully insured group block was somewhere around 26%. Every single BUCA carrier has signaled margin recovery won't happen until 2027. We missed our target loss ratio by 30%. They're signaling what's going to happen the next probably 2 years, which means it's going to be as bad or worse. And if you sustained a surprise 30% increase, you might go, golly, that stunk, but we weathered the storm. Let's hope it doesn't happen again. You can't do that 2 or 3 years in a row, most businesses. And I've heard people get 70 to 90 to 100% increases out of nowhere. So what I think is happening, and why I agree with Dr. Bricker, is you're seeing a splitting of this risk pool, where those that can leave to an alternative funding solution are doing so. And what's left over or what remains is a worse or dirtier risk pool in the fully insured space. And once it gets in that death spiral, the reason it's called a death spiral is it's terminal, meaning there's not really any way to get out of it. And so what's left, I don't know, but it'll likely be definitely shrinking market share and a lot more people with rates way higher than they could have ever imagined. And if they haven't jumped ship yet, they probably should, quite frankly.
Yeah. And I think about it like on the workers' compensation side, if you have really terrible losses and an insurer you can't find an insurer to cover you, they have state funds. And so you can go into the state pool and the state has to cover your loss or your insurance. And it's almost like it could head in that direction where the fully insured market would just be almost like a catastrophic emergency fund for people who can't get it anywhere else.
Yeah. What I do worry, and not even to sound conspiratorial, but are we seeing the managed decline of the private or commercial insurance market where people will beg at some point to have it replaced by some sort of single payer version of it? I don't know if that is the case, but I could see that as a possible outcome if we don't do something different.
Yeah. The BUCA carriers, and when we say BUCA, folks, if you're not familiar, that's Blue Cross, United, Cigna, Aetna. So BUCA, those are the 4 big carriers. Humana used to be in there. There were some others before that, but it's consolidated down into a big 4. So I will try as much as I can to catch the acronyms and spell them out when we say it.
I heard somebody call it the Cubas instead. And I'm like, they just inverted the acronym. And I'm like, I guess that works, but BUCAs is what everybody knows.
Yeah. Cubas has a whole different connotation.
It has a different connotation. Yeah.
Yeah. I may use that in certain scenarios. So let's go back to a couple of the fundamentals because we're getting into deeper water here. But I had a conversation this very morning with a gentleman and they are fully insured. They have a lot of people on their plan. They have about 1,000 people on their plan, but they're still fully insured. And the lift of moving, the risk of taking on the additional volatility, the volatility scares the CFO. The lift of it or perceived lift of it scares the HR team. What is the lift to switching from a fully insured, hey, I just pay my premium to the carrier, to a self-funded model where now I got to set it all up and manage the whole thing?
Yeah, I would say obviously depends on if you unbundle or bundle, meaning do you move completely away from a carrier, which would be a bundled self-funded solution because Blue Cross will offer that to you, UHC will offer that to you. You would argue that might be a little bit less of a lift of that conversion. But in my world and a lot of the world that the people I know exist in, which is we're going to pick a TPA and a network and a PBM and a stop loss carrier. We're going to unbundle those things. And so you could argue, and that is a common objection that I feel in my world, which is this sounds like a lot of work and how am I supposed to manage it? The reality is there's 2 realities, actually. One, a lot of that work falls back onto guys like you, the consultants themselves, who are being paid for the advice and the strategy and the service, et cetera. The other part is once you power through the initial change, which is setting those accounts up and getting used to claims reportings, et cetera. Once you get through that, then it becomes routine, just like riding a bike becomes routine once you've got it. And then you start to realize all the upside and benefits of doing so. I'll tell you a true story. We were at an event where we do employer-sponsored events with consultants and some people show up to hear about what we do. And this lady had been in our program before as an HR director. And she said, hey, I want you to know this. I was in your seat before and I was scared of making this transition, but she literally used the word fun. She goes, once I got into it and saw the claims data and what I could do, like it was fun for me every Monday to log in and look and see what happened in the plan or what I could do about it. I've never heard it be described from the HR seat as fun, but I was like, okay, a lot of it depends on your mentality. I think though, to sum it all up, if you remind yourself the why behind why you're doing that, then you can endure the how. And the how is really technical and be supported by vendors and folks like you as well. And once they get through that, they're good. So you want to cover the other part too, the perceived volatility component then as well?
Yeah, go ahead.
Yeah. And so what kind of things do you hear? Because I can answer maybe specific objections or I can give you generally what we hear as well.
I would be curious what you hear the most. The thing that we hear the most is just specifically on the volatility side is just the fear of volatility. There's like private equity funds, or if you're owned by private equity and there's an exit coming up, there is some value potentially to having stable, predictable costs that the new buyer can run through their models, and the volatility might not be there in that scenario. But other than that, it's mostly just, I know what my costs are and I can predict them.
Yep.
Maybe we're a low margin business and I'm nervous what this is going to do to my financials.
So one thing I would say to that is being fully insured is very predictable 12 months at a time. The 13th month is where it is wildly unpredictable. And we call that fully deferred, not fully insured. So you're deferring it 12 months at a time, and nobody tells you ahead of time what next year's renewal is going to be. And when we literally looked at a group that was self-insured, got scared, ran back fully insured, got a 97% increase their first renewal fully insured, and then panicked and wanted to come into the captive 3 years later than they should have. That's the reality. Is like, yeah, it's very predictable in 12 months. It's not predictable after that.
Ouch.
The other thing that CFOs get hung up on is when your maximum liability, and I'd be remiss, I don't know if we'll be able to fully explain what that means, but your worst case scenario, self-funded, is usually a little bit higher than your worst case scenario, fully insured, which is also your best case scenario. It's guaranteed in those 12 months. And so they may look at the probability of outcomes almost like a bell curve and go, well, my exposure might be 10% more than if I just stayed fully insured. What they don't think about is if you had that same bad year fully insured that you're worried about when you're self-funded and you hit that maximum number, your renewal increase is going to be gigantic as a fully insured employer. Whereas if you're self-insured and maybe some bad risk leaves the plan or you get a source of drug better, all of a sudden you could offset your costs 25, 30, 40% the following year. You get in this game where when you're fully insured, you keep presuming it's going to stair step its way up. They forget when you're self-funded, yes, 1 year could be hot and 2 or 3 years in a row could be way below budget. They just don't even have the opportunity to participate in the upside right now if they stay fully insured.
Yeah. Well, and as anyone who manages all of this stuff knows, like the carriers are not going to go backwards.
Oh, yeah.
They might give you a flat renewal, but I've seen it happen, 2% decrease or something like that, but it is very rare.
Some carrier will buy your business sometimes, right? And they'll give you a 15-point decrease to move to them. And then they put you on the same trajectory after that. And then you've got to do it all over again. But you're just trading logos and then basically buying down the problem a couple years at a time. You're not solving the problem, though.
Yeah. Are there any other fears that you hear, whether coming out of either HR or finance or anybody else?
Yeah, I think people have had experience 10, 15 years ago sometimes where they're self-insured and they weren't appropriately set up with the right stop loss, the right partners as well. And they go, yeah, we've been self-insured before and it didn't work, so we're never doing that again. But the reality is they probably got some bad advice. They probably didn't have the right programs in place. And so I think that is one of the common objections we hear from small business owners who have tried it. They've got a bad taste in their mouth. And we try to help assuage their fears, right, by having a better framework. The reality is some of them have just got that stuck in their head that it went poorly at one time. And so I'm never going to look at it again. And you just have to deal with that.
What are those mistakes? Like for those that you've seen who've gone through it and it didn't go well, what are the common mistakes you see them making?
So I'm going to say them, and I might have to explain what I mean by a couple of these. The first is a lasers allowed contract. And so what that means at renewal, let's say you have one really large claim. The stop loss carrier might come back to you and say, we can't take on the risk of that one really large claim because it's going to keep going. So we're going to push a ton of that risk back to you as an employer. And so let's use an example that's very common, a hemophiliac that might have $700,000, $800,000 a year of medication. That's predictable, ongoing. They need that maintenance medication. So if you had one of those pop up in the beginning of the year, in the middle of the year, and you have a lasers allowed at renewal contract, that stop loss carrier is not going to take that risk. They're going to say, O'Brien Inc., you have a $700,000 laser on this gentleman right here, and you now have to pay for all of the cost of that person. So that lasers allowed contract will look cheap sometimes, and people will buy it because of that. And I've seen it burn employers so many times as a result.
And
so
just to be clear, I want to clarify for people who may be lost in some of the terms.
I realize that. Yeah.
So just to define, stop loss insurance is that extra level of protection that Spencer was talking about before. So even if you're self-funded, you're still buying insurance to cover the aggregate cost. You're buying that insurance, which has an individual limit. So if any one claimant hits a certain level, the stop loss will kick in and pick above that. And then it has an aggregate. So if all of your claims in aggregate hit a certain level, it'll pay above that too. And so that's what he's talking about here, where maybe you have $100,000 individual limit. And so if any one claimant, any one person on your plan has $200,000 in claims, you're only going to pay 100, and then the stop loss plan will pay the other 100. But if they know that there's an 800 out there, they'll say, no, on that one person, we're going to laser it, and you have to pay the full 8 on that one person, but then everyone else will cover at the normal 100. So just to be very simple about what that is. I'm very
glad you did that. And we didn't have a chance to actually explain the parts of stop loss. So thank you for stopping me there so I didn't skip that beat. But I think of stop loss insurance at the individual level as the corporate deductible. So what does your corporation have in terms of risk tolerance of how much you want to retain per person before you offload that risk to a stop loss carrier? The issue they get themselves in is chasing that cheap stop loss contract and not thinking about what happens when something really material arises and goes from unknown risk to known risk, which is where that laser comes in. The other one, which, hey, should we take your audience in more in the weeds or not? I'm worried about
Let's go.
The other one, which
we've taught them how to swim. Now we're going to
taught them how to swim. Okay.
Yeah.
The other one that I see happen frequently is they buy what's called an immature stop loss contract in year 1, and they don't understand what to do in year 2 to make that mature. And the easiest way I can explain that is there's a thing called a 12-12. It's claims that are paid in 12 months or incurred in 12 months. When do they happen? And in the same 12 months, those claims have to be paid. When you're self-funded, there's a lag. So that claim might happen in a 12-month period. It might take 4 more months for that claim to be paid. So that's a 12-12. That's immature, meaning it looks great on paper, but it's not mature coverage for you as well. So where does the mistake come in? It's not necessarily year 1 getting the 12-12. It's not doing what you're supposed to do in year 2, which is maturing that contract. And I will stop there from going way too deep. But when you don't align those 2 contracts and a consultant doesn't know what they're doing, quite frankly, the employer will buy contracts that have gaps in them, and that will leave them massively exposed in between those gaps. And when that gap happens, they're on the hook for 100% of somebody's claim at that point. And that is where I've seen it blow up a lot. And it blows up really bad when that happens as well.
Yeah. The other thing that I've seen, which is along those lines, is where, so back to the mature versus immature. If you start and switch to a self-funded plan, in January of that year, that first month, you're going to have people going out and going to the doctor. You're not going to be paying those claims because it takes time for the claim to work its way through the healthcare and insurance system and then show up in your invoice. And so you're going to have all these claims that hit, but you're not going to pay them until later. And so when you look at your budget of expenses for that first 12 months, you're like, wow, we saved like 15 or 20% off our total cost. This is amazing.
Yeah.
And the problem is if you're budgeting on that number, you're in for a doozy of an increase, because the real mature way to look at it is to project out another quarter at least into the next plan year. And so you always have to be accruing for that, what's called incurred but not reported. And so you always have to be accruing for what's sitting out there as a liability. And again, this is where this feels more complex than it really is.
Right.
It's really not that hard to set up. It's a little hard to understand at first, but and this is where I think people would be like, incurred but not reported, I got to do this lag and this, I don't know, this is just too much. And it's really not. With a broker's help, it's pretty easy to set up, and the broker will do the reporting and give you the IBNR, all of that. But it's the one thing where I've seen people get in trouble is where they see the immature number and they go, oh my God, we're going to save 15%.
Yeah.
And then that second year, that 15% comes back and they get trend on top of it. And they're like, I got another 33% increase. And it's, no, you didn't. You got a 6% increase, but you just were looking at the plan the wrong way.
Yeah. And then the situation you just described, one of the advantages I think of that first transition from fully insured to self-funded is exactly because of that lag. So a disciplined employer that understands what you just described for year 2 has a couple months to start building up plan reserves by being disciplined in how they fund it. And when the claims start to flow through the system, then of course they're going to be paying for them, but you've banked some cash in the first 45 to 60 days that give you a cushion going forward as well.
So this is a good time to talk about savings, because I just said people kind of look at that the wrong way. Apples to apples, like what do you typically see if the plan runs as expected What do you typically see as savings from moving from a fully insured model to a self-funded model?
Well, I mean, I guess I can give you concrete data from our world in captives, and maybe we'll get into what a captive is if you want.
Yeah.
But we typically see somewhere in the neighborhood of about 7.5% in the first year, and that trickles up to around 16 to 17%. And that is our own analysis, but also backed by Milliman that says this is what the transition typically looks like on average for a group, which gives confidence, of course. And then you might ask the question, why does it improve over time? Because they're comfortable being self-funded. They start to take advantage of the tools that are available. They start to tinker with the TPA or the PBM to get better versions of those things. And so the idea is it's an evergreen process, and the better you get at it, the more likely you can save. This is also where I caution first year self-funded transition sometimes also costs more. And if an employer does that and gets really scared because it actually went a little worse than they expect, that might scare them away in the future. And we usually say statistically 1 out of 5 years are a bad year for an employer, meaning their claims are worse than average. And so you need to expect that it's possible that bad year is also in year 1. And you can't let that leave you with a bad taste in your mouth as well. Otherwise, you'll actually make decisions that are too reactive, and it'll send you back to the world that you just exited. And I think that ends up doing a disservice to everybody when that happens. I may ask you this, and you guys at Lockton have tons of data and have a great stop loss COE and those type of things. So what do you typically see, or what do you tell clients when they're considering this move?
7 is a little higher than we typically see. We typically are seeing something like 4 to 5%.
Okay.
And then to your point, that can mature over time if you are aggressive with the plan.
Yes. Yeah.
It might be a good way to segue into specifically what you do, because I think there are 2 parts to this. You've talked a couple times about unbundling. So right now, fully insured contracts. And then if you switch, a lot of self-funded contracts are bundled, meaning your medical and your pharmacy are together with the same provider. You can unbundle those and have a separate medical network from your pharmacy contract. You can even unbundle some of the care management services and things like that. So there are savings to be had and optimization to be had in unbundling. Mm-hmm. But then there's also this ecosystem that you now can build of different point solutions and navigation vendors. And we'll talk about what all these are, but there's all these different things that you can now bring into the ecosystem to support the member and get them to better care at a better time for better cost. And so there's 2 levels to like what you can control. And so I think that might be a good segue into what is Pareto? Like, what do you actually do for a job?
I appreciate that. And I do want to get into what you just described here in a moment as well. But so let's give the technical terminology. Group benefits captive, right? People go, what does that mean? Think of a captive as a way that smaller employers, and I say smaller, call them 50 to 500 lives or so, that middle market. What is the way that they could band together, both in terms of buying power for point solutions and also for stability in their stop loss? And a captive creates the framework and a risk structure which allows them to be able to do that. So they still have their own stop loss policy. They still have a carrier, but ultimately the risk is then diversified across a much bigger pool. So that makes it more predictable over time when they get their stop loss renewals. There's nothing wrong with a 100 life group going self-insured. What they have to expect, though, is some volatility year to year in what they experience on their own at that size, versus a captive says, what if we could make you the size of a Fortune 100 company or Fortune 50 company? That would give you the confidence and the reassurance that on a multi-year basis, you'll be safe or insulated from that volatility. That's what the captive is. And if I had to give you, because I know we want to keep it simple, bumpers on the side of a bowling lane. When you're not good at bowling, you put them on there. It doesn't guarantee a strike, but putting those bumpers on the bowling lane stops you from rolling a gutter ball. Think of a captive's goal is to stop you from rolling gutter balls when you're self-insured.
And this might be a little bit too much in the weeds. We'll see how you can skim across the surface of this one.
We'll make sure your audience, hopefully we can bring the audience with you.
Because there are different captives out there. Can you talk to the different ways that captives structure that protection? Because the protection can be different depending on which captive you go into. So I guess, how do you guys structure it? And then what do you see as some alternatives out there?
Yeah, and I guess I'd be remiss because I don't want to get too in the details of proprietary information just to be a little bit safe. But let me just describe different structures and Sure. I'll describe which one's ours. So there's a fixed layer. So a fixed layer is I have my own stop loss deductible And then the captive takes on risk to a set amount. And across the board, no matter what underlying deductibles are, it's now set, okay? Floating layer is, I'm going to add $250,000 on top of every single employer's spec deductible, regardless of what that is. And it floats around on top. Both of those designs, though, are designed in such a way that the captive is taking all of the risk inside that layer. And a lot of times in a couple $100,000 range, that's where the majority of your risk is impacted when you're self-funded, okay? Our version is what's called a quota share. And so that quota share extends the layer on top of the spec up to a much higher level and then splits it with the carrier and the members. So now you have the stop loss carrier participating in the captive layer and sharing in both the upside when things go well and in the downside when things don't go well. And our belief or thesis is by extending that layer, giving the carrier participation in it, that's going to incentivize them to want that pool to run better. And so they give discounts and things like that for all the point solutions that come along with it.
So just to maybe say that a different way, and you can tell me if I have this right, is the member companies that are in there are going to participate a little bit earlier than they might otherwise.
Yeah.
But it's going to be a slower drip.
Possible.
So as their costs start to accrue, the carrier's costs are going to start to accrue, but the client is going to accrue costs slower and the carrier is going to eat through their budget slower. And so you get to hopefully a better equilibrium where everybody's incented to keep the cost down. It just aligns the incentives.
That's exactly
Is that
right.
what you're saying? Okay.
Stakeholders are all now on the same side of the table versus a stop loss carrier doesn't necessarily in a fixed or floating layer design where all the captive is taking on all that risk in that layer. They're not really as concerned about that layer. They only step in after that. By putting the carrier in that diverse pool, that gives them the rationale to want to make sure it runs better as well. And so that incentive structure, we think is a big reason why we've been really successful.
Okay.
That's probably the most technical. I've probably got into any podcasts about captives. Here, let me say this one thing, man. I think some mistakes that other captives make is impressing people by how sophisticated their construct is and forgetting the why behind it, the story behind it, things like that. You've got to win over the employer emotionally as well as cerebrally if you want to convince them. But if you only go in there and you throw all this technical jargon at them, they're going to look at you confused and they're not going to do it, even if it is the right thing for them to do.
Yeah. No, I think that's a good point. And essentially being in a captive is just being self-funded with a few other nuances to it, right? You might argue that because you're in it every day. It's complex on the back end. But for the employer, there's just a couple things that they need to pay attention to. They don't need to know how the entire sausage is made because they don't. It is
stop loss policy. It'll say what their deductible is. It'll say what their attachment point is. They sign that stop loss policy with that carrier. To them, it feels exactly the same on the front end. The captive manager's job, like Pareto, is to do all those nuances that we just described behind the scenes.
Yeah. So what are the other nuances of a captive beyond just the shared risk in stop loss?
Yeah. Well, there's two things that come to mind immediately. One is you're going to have to post some sort of collateral or capital as a buy-in to the captive. So why is that? Think of a captive like an insurance company. And an insurance company by law is required to have reserves. So how do we do that? Some captives require collateral where you post that collateral and it's used for that purpose. Or with us, it's capital, which is more of an asset on their balance sheet and can be invested in things like that. But think of that as the captive's rainy day fund. So if I exhaust my captive layer, regardless of design, I'm going to have to dip into that collateral or capital to pay the remaining claims. And so that is your buy-in to the country club or your membership fee, however you want to describe it. It is there for a technical purpose, and it is a feature of any captive that you're going to join. That will be part of that buy-in. Now, some of them require it every single year. Some of them can come back to you and ask you for more money throughout the year if it's at a deficit. Or some of them only require capital the first 2 years, maybe like ours. And so they're all different. And the one thing I would say to people listening that have looked at captives, every single one is different. And so if you're doing your diligence, they're all going to have slightly different pros and cons. And you should investigate those to make sure you find the right one. The other thing, okay, so I mentioned too, this is the stuff you were mentioning earlier, O'Brien, is that most captives then bring along, because we've got the construct, we've got your risk financing taken care of. What is the other side of the equation? The other side is 60 to 70% of an employer's plan spend is claims. So if you're not addressing the underlying cost, your insurance is going to perform poorly. So whether that's point solutions for direct contracts or pharmacy or MSK, you name it, most captives bring along a solution set that says, we've gone to market, we've used our scale to get you, and they either require you to use them or they make it optional to use them. But they want those employers to be using those tools because they know that delivers better outcomes and the captive stays healthy. That is unique to the world of captives, where if you're just self-funded on your own, then Lockton's going to be the one bringing those solutions to the table, not the captive instead.
Yep. Yeah, that's what I was going to say is like, for every group that goes self-funded, every group that we're working with that goes self-funded, the next step is, okay, now how do we unbundle this? How do we build an ecosystem? How do we put the right pieces in place to be lowering trend over time? And there's an element where the client has to be involved in those decisions. And I think working with a captive is just a little bit more like taking something off the shelf. And these are the pre-vetted ones for this ecosystem. And so it's a little bit of an easier lift to be like, okay, I don't have to, as the client, think about which ones I'm going to use. The captive is going to work with my broker and they're going to come with the prepackaged ones for me.
Yeah. I think I heard somebody call us the Apple store before. So once you get in Apple's ecosystem, right, I've got a MacBook right here. I've got an iPhone right here. You get your AirPods. All the things start to integrate well with each other. And you find yourself going, oh, I've got all of the needs taken care of at once. Where some people might go, you know what, I'm going to pick a Samsung phone. I'm going to have a Microsoft laptop, whatever they want to do. Some personalities gravitate towards that complete flexibility. Some people say, integrate me into a pre-vetted ecosystem that I know works really well together. And that is my preference as well. This is why there's a spectrum of solutions out there for every type of employer, and captives are only one of those solutions.
Yeah. As you're thinking about the ecosystem that Pareto has built,
yeah,
what interventions do you see working the best? How much of it is tailored to that specific client, and here's your utilization patterns, and here's gaps in care, and we're going to close those? And how much of it is, we just know that every client needs something like this and it will save them money?
Well, I would say pharmacy is where we start. I don't think we've touched enough on pharmacy yet, but I describe pharmacy or the PBM contract often as the lowest hanging fruit in the plan, especially fully insured with a BUCA. So when you get into things like rebates and who's getting the rebates, and you get into spread pricing and you get into formularies, and these are all technical things, the reality is by just having simply a better pharmacy contract from day one, you should realize savings in the 25 to 35% range or so on pharmacy alone. Now, it's a smaller part of your spend, don't get me wrong, but that might be the easiest thing to tackle for an employer in year one that's not ready to go all the way. Then you're going to start to get into case by case specifics, right? So people might have high infusion costs where somebody's going and getting a J code infusion at a hospital that's costing hundreds of thousands or $1 million a year. You have cancer spend. This is why some people, and I think a lot more people, are gravitating towards the captive, because you have off the shelf for any one of those things and you don't have to go out to the market and find them. But not every employer we look at is going to have the same problems in their plan. But most of them are overspending on their pharmacy. There's little doubt on that.
Yeah. So just about everybody has an issue with their pharmacy contract or has an opportunity with their pharmacy contract. And then as you go down, like MSK, cancer, like most employers will have those. And then there are some others below that will be more sporadic, but having the ability to pull something off the shelf when you need it and align it with your claims is important.
Totally. And you want to know the most expensive single claim? It's premature babies. There's almost no doubt that premature babies are those that stay in the NICU for a period of time and have multiple surgeries, as sad as it is. Those are multi-million-dollar claims, unfortunately. Yeah. The reality is, it's not like you have a crystal ball to know when one of those are going to arise, and the interventions that exist, you have to be right on top of it, and they're more of risk diversion than they are solving for that particular issue. And so no matter what we do in this risk business, there's always going to be a whack-a-mole where something else pops up and we have to do our best with whatever we got.
Yeah. So let's go back to pharmacy. I know there's more layers to unpack there. Yeah. How do you guys think about pharmacy and what makes a good pharmacy contract versus not?
It starts with rebates. Rebates are number one. So let's describe what a rebate is and maybe the problem that it presents. A rebate is like you would get in a rebate if you go buy a TV from Best Buy and they promise a $100 mail-in rebate or whatever, right? You're going to get some money back. The issue, there's a couple issues, but one of the issues is oftentimes the PBMs themselves are collecting the rebate, either all or some on behalf of the employer. So you have a middleman that's helping to establish pricing and establish the formulary that's also extracting dollars out of the equation for themselves. That's problem number one. The formulary is simply what drugs are in what tier and what are the copays associated with that tier. Problem is the PBMs want certain drugs with really high cost and high rebates incentivized higher on the formulary so people fill them. You pay your $20 copay, $100 copay. You have no idea what the drug is, but the PBM has set up the formulary to get you to fill that drug because they want the rebate, right? And so you look at that incentive structure and you go, that is the broken part of the system. And there are more things than that. That incentive structure is bad. So what if, let me give you an alternative. What if instead of filling a Stelara, that might be $80,000, $90,000 a year with a 50% rebate? And even if I'm the employer and I'm getting that rebate, I'm still spending $40,000, $45,000 on that drug. What if there's a biosimilar drug, which is molecularly interchangeable or very similar? Rather than me focusing on, am I getting the rebates back to me? What if I incentivize that drug to be filled? And that drug might be, in this case, a Tolfi is like $6,500 a year instead. So lowest net cost, how do I get the drug cheaper? Makes me not worry about chasing rebates anymore. And I think the industry has gotten a lot of people to say, look over here when they should be looking over here.
I think they've gotten a lot of people addicted to the rebates because the rebates are sizable. Yeah. And it was interesting. I was listening to a podcast. I may not get all of this right, but it was talking about what makes something addictive. And it was that there's a regular reward that is varied and you don't know when it's going to hit or what it's going to be. I think those were the three things. There might be one other. But if you look at what it's like slot machines, like if you play slot machines, you know there will eventually be a win, but you don't know when it's coming and you don't know how big it's going to be. Could be really big or it could be nothing. But it's that something about that psychology just hooks us. Like it's just cracked to our brain. And so if you look at PBMs and the way they've structured rebates, that's essentially what it is. But you're going to get a rebate. You're not exactly sure what it is going to be. It could be really big or it could not be. And you could use money to do other things in your budget. And so they use that mechanism to get you hooked on it.
It's almost gamifying it, right? To a degree.
100%.
Yeah. And that's, again, like our industry, and I'm a participant in it. Our industry does a very good job of manipulating human behavior to create those reward systems. And it's to the benefit of the stakeholders of that system. It is not to the people being, I say manipulated, as I know it's a strong word, but that's exactly what's happening in the equation you just described.
Yep. Yeah, except it's happening to your finance team.
What's happening to your business? And you think about being a fiduciary. What does it mean to be a fiduciary, especially when it comes to your health plan? It means you have an obligation because you're using employees' funds to go make purchasing decisions. And you start to get yourself, when you really look at it that way, you go, am I being a good steward of my company's finances and my employees' finances by entering into some of these contracts? And then when you start to ask those questions, you start to look at those incentive structures, then you start to realize most of the time the answer is probably not. And I might have some risk associated with that as well.
Yeah. And the market on pharmacy has moved drastically over the last 15 years. Every year, the traditional contracts get a little bit clearer. And then now we've seen even new vendors come on, which I know you guys work with, a lot of them, which are fully transparent pass-through PBMs. And I think we're just going to continue to see that trend. It was interesting, though, back to Dr. Eric Bricker with his healthcare videos. He did one, and we'll find the article and link to it. But there was an article about how the big three PBMs, because Blue Cross, United, Cigna, and they all own their own PBMs, and that's where 80 or 90% of pharmacy spend funnels through those. So they're making a ton of money there. And there was a really interesting article about how, I forget the exact numbers, but it was like 10 years ago, they were making something like 70% of their revenue off the rebate, VIG, the piece that they were taking off the rebate. And they saw the writing on the wall that it was going more transparent. And so they've actually set up these other entities that get fees rather than taking it off the rebate. And they've shifted so that rebates are only about 20% of their business, but about 50% is now going through these other entities in the form of fees. And so they have gotten very savvy in how to change their business without losing revenue. And now you're seeing like Cigna came out and saying that they're going to offer a fully transparent pass-through PBM. And everybody's going, oh, isn't that great? And it's, yeah, but they've shifted the way they make all their revenue. So that doesn't actually, they're not going to lose any money doing that.
No, that's just it, man. And what are they doing? They're acting in their obligation to their shareholders. So you almost can't begrudge them, right? And maybe undue influence through lobbying and things like that, but they are fulfilling their obligation to their shareholders. And so they're doing exactly as demanded of them. So we just have to try to be as savvy as them. And I'm not demonizing any one of them, but that's the reality of this game that we're all participating in. And my whole goal is to do the things on behalf of the employers as much as conceivably possible, with knowing it can never be perfected. We can never outrun this exactly. And we just have to do our best to try to stay in front of it as much as possible.
Yeah. Well, and going all the way back to the beginning on the fully insured versus self-funded, if you're fully insured, that's where your pharmacy claims are going. And you're not getting those rebates. The PBM is keeping those rebates because it's running through a fully insured model. And so there will be some rebate factor in your renewal, but you're not reaping the full benefit of what your drug spend will be.
Not even not getting the rebates. They don't even know most of the time what drugs are being utilized as well. So your pharmacy goes up dramatically in 1 year. You may not even know what drug is that on my plan. I can't tell you how many groups we've underwritten where you have no idea how to price some of these claims because there simply is no data to price off of.
Yeah. Anything else on pharmacy that you want to hit before we move off of that topic?
I think rebates are the biggest thing. Spread pricing is obviously a topic of conversation right now as well. I don't pretend to have all the answers on pharmacy. That actually is not my area of expertise. But the reality is if I could just point people's eyes to that part of their spend, that's a good place to start. And then they hire somebody like you to go help them figure it out.
Yeah. Want to stay on point solutions for 1 second. Okay. And the question is, there's a lot out there. Is there anything that you have found through your work that makes adoption of those point solutions more successful at a company versus less successful? Like, how do we get people to engage in those solutions so that they are getting better care faster for lower costs?
There's 2 ways to do it. One, I think employers have to realize that effective communication of those point solutions on an ongoing basis is required. You don't just do open enrollment and say, we've got this new thing, and then everybody forgets about it because where their eyes go, they go to their contributions in the booklet and how much does it cost me this year? So effective communication by the HR staff, trickling that out is probably one answer. The other that I think is important, and it's probably at the point of table stakes this year, or at this point, and I want your opinion, care navigation, right? Some sort of care navigation tool that assembles all that, whether it's in a benefits wallet or a third-party care navigation entity that can step in and proactively steer people to these solutions. You have to have something that puts it in their hand and makes it easy to understand. Because you and I talk about this all day long, every day. These people that are just going to work and then find themselves in a situation where they need care have absolutely no idea how to navigate the system. So care navigation becomes crucial as well. And that comes in many forms. So I'm not going to necessarily say it should be this one or it should be this one. But care navigation at this point is table stakes if you want to do self-funding right. Otherwise, you run the risk of either lower utilization and adoption or confusion of your members.
And so what is care navigation? You want to dive a little deeper just into what that term means?
Let me give an example. So I can speak through our ecosystem just as an example. So we're using RightWay starting 7/1 this year, and everybody's going to have access to RightWay. We've partnered with HealthJoy in the past, and HealthJoy is still available, but RightWay is now going to be the deployed solution across the country for Pareto. So what does that do? Benefits wallet, your medical plan, your dental, vision, life, disability. But let's say they have the KISS card. We offer the KISS card, which is now Valence, but it's direct contract and imaging for things that people might need throughout the year. KISS card's going to be right there. They're going to know, oh, I have cancer care available if I find myself, unfortunately, in a position of cancer. There's going to be access to those entities. If you integrate it properly through a TPA that's feeding all that data to all these vendors as well, now you can catch those things in real time and start to steer those people to the providers that are in those particular networks. That's what I describe as like real consumerism. Like high deductible health plans used to tout, give people skin in the game with cost and they'll be better consumers of healthcare. The opposite typically happens for most people. So this is consumerism in the form of a tool is in my hand and I'm now steered or guided where to go and what benefits I have. That's the best way I could describe a care navigation tool.
Yeah. Well, and I think you answered my next question too, which is what changes have you seen in employee communications over the last 10 years?
I'll give shine to, and I hate to do that because it's another consultant, but Matt Rouse and his sister have a really cool app. I think they're now part of another agency, but they created like Holly's Health Talks. And she just records these really cool videos that are like 30, 60 seconds at a time. They batch those to employers to say, these are the things in your plan. Let people watch these whenever they want or drip them out over time. And a very simple explanation of, she used to be, I think, an news anchor. So she's great on camera.
Oh, there you go.
Really cool idea, right? Create bite-sized, easy to digest videos that explain these things and remind people that they exist. If you think how most people consume content these days, it's scrolling on TikTok, it's scrolling on Instagram, it's really quick. Nope, yes, you stay. How can you meet people where they are, especially younger generations? Really accessible bite-sized content is one way to do it. Then texting and all the things, your phone, man. What is a read rate on text messages? It's well over 90%. So why don't you just have text message drips that you drip to people out throughout? You just got to be creative about this.
Yeah. No, I think that's great. And I think the one that I was going to add would be something like a Right Way or a Health Joy. I think creating a hub through which communications run that is modern, that offers video, text, but the opportunity also to engage with people, the opportunity to engage with an AI bot. You can build all of that into one hub now. Yep. With the spokes all around it. And I think that is the easiest thing. I saw probably from 2014 through 2020, it was like, how do we add more? How do we create more point solutions? How do we meet people where they are? How do we have something for everybody? And it just got to be too much. And it was like, we can't expect people to know where to go for everything that we're offering. And so on the one hand, we've pared that back a little bit, but on the other, rather than build the ecosystem and let them go forage within it, it's like, no, let's just build one portal. And then through that portal, you go out and we'll harvest everything that you need from the ecosystem and we'll bring it to you.
Yep. Everybody's fighting to be the front door of healthcare right now. And why do they want to be the front door? Because they want everybody to find a centralized entry point for everything they need. Because of all these disparate parts, it's difficult to understand if you're not in this world. And so that front door, whether it's an app or a hub or an entity who you call into, that front door to simplify the entry is really crucial in having success here.
Yeah. Spencer, this has been a ton of fun. I think we accomplished the mission. I don't know. Hopefully people will write in and tell us if we did, but I think we taught people to swim. We got into some deep water there a little bit, but that's okay. We hopefully threw some people some life rafts and talked them through it. But I think this will be helpful for folks because this conversation is only happening more and more. I mean, I see it every day. It's happening more and it's happening with smaller and smaller companies. And so I think having something like this out there will be helpful for folks. So appreciate you coming on.
Yeah, I'm very grateful for the chance to do that. I usually am sitting on the other side of the table like you are, and it's fun to every once in a while get a chance to be a guest. So thank you for giving me that opportunity.
Yeah, you've clearly absorbed a lot of the information. So good for you.
So. Thanks, man.
All right. Good luck to everybody out there. If you do have questions on this stuff, obviously this is one of the times that I'm covering a topic that I actually do day to day. So reach out, let me know, reach out to Spencer directly, ask him questions. If you want to learn more about Pareto, we're both here to help if these are topics that speak to you or might solve some of your challenges. Best of luck out there with this year's benefits planning cycle.
Hey folks, one last thing before you go. If you enjoyed the episode, make sure to hit subscribe so you can stay up to date with future guests. That's it. Thanks for coming. Go make the most of your business and the people in it.